Welcome, learner. You shared an intense stack of financial intelligence covering the first weekend of 2026, and our mission today is to, well, cut through the noise.
Exactly.
This isn't just a simple market report. It's a deep dive into the macroeconomic tension that's really shaping investor choices right now. We have these two massive forces just pulling capital in opposite directions.
That's the core of it, really. We're looking at a market that's stuck between two persistent things. Interest rates that have settled in that mid to high range, and this surprisingly sharp volatility in short-term liquidity right at the end of the year.
And that's the puzzle.
That's the puzzle for you, the learner. Understanding what this environment where you have high-risk growth like NVDA and BTC driving prices, but deep defense like gold is just as strong, what that means for your own portfolio's risk appetite.
Okay, let's unpack this tension. I think we have to start with the long-term anchor, that continuous pressure from U.S. Treasury yields. The market keeps hoping for a major shift, but the numbers just aren't showing it.
They really aren't.
What are the key yields we need to be watching, and why are they still such a drag?
Well, the anchor is holding firm. We see the bellwether 10-year yield solidly in that middle to high range, around 4.15% to 4.18%.
Okay.
And then the short-term 2-year yield is hanging around 3.4% to 3.5%. The reason these numbers are such, continuous pressure is that they dramatically affect valuation, especially for growth stocks.
So just to spell it out, when we're talking about growth stocks, these rates are forcing investors to discount future earnings much more heavily. If the cost of money is 4 or 5%, that big profit you're promised 5 years from now is, well, it's just worth less today.
Exactly. These sustained rates act like a brake pedal on any sector that's relying heavily on optimistic future projections. It demands discipline. It demands real, immediate profitability.
Which is why the whole AI narrative has to deliver results, not just hype.
It has to deliver now, not just promises.
And speaking of delivery, the Federal Reserve is still the elephant in the room. We know the market's trying to price in rate cuts, but the Fed itself just seems so conflicted.
Yeah. Absolutely. The timing and the magnitude of any potential cut are still just policy expectations. They're not certainties.
It all depends on the data.
It's highly dependent on the upcoming releases employment data, inflation data. The CPI and PCE reports are the critical variables here. And right now, the U.S. employment picture is remarkably resilient.
Still strong.
Very. Non-farm payrolls, unemployment rates, they show no clear deterioration. And that gives the Fed less of an urgent reason to pivot and start cutting aggressively, even if the broader growth picture is, constrained by some supply-side uncertainty.
Okay, so that sets the macro stage, but now we get to the part that's, I think, really interesting, this seasonal liquidity puzzle at year-end. You mentioned sharp volatility. That sounds technical, but it has real-world consequences for how banks manage risk.
Oh, it really does.
So, can you detail what happened on December 31st?
It was this fascinating event of passive scheduling. Many reports just quickly labeled it a seasonal technical phenomenon, not a true systemic collapse or anything like that.
Okay, so not a crisis.
Not a crisis, but the magnitude was just staggering. We saw the New York Fed's standing repo facility, or SRF. It hit a record high in borrowing. We're talking approximately $74.6 billion.
Wait, just for the learner, what is the SRF? What does $75 billion in borrowing actually tell us?
The SRF is essentially the Fed acting as a backstop. It's where eligible banks can go to borrow cash short-term against their Treasury collateral. So when borrowing at the SRF hits a record high like that, it means there was this unexpectedly high demand for immediate cash.
Institutions were scrambling.
They were scrambling for liquidity to manage their year-end balance sheets.
So banks were rushing to borrow cash. But didn't we also see a huge inflow on the other side of the Fed's ledger?
Correct. On the very same day, you have the overnight reverse repo, the on-RRP, and that facility saw an inflow of about $106 billion. And that's where the Fed borrows cash from money market funds, parking their liquidity overnight.
That seems like a total paradox. We have institutions borrowing record amounts, which suggests a cash shortage, but then money market funds are parking over $100 billion with the Fed.
And that highlights a classic case of, really, distribution inefficiency.
Yeah.
It's amplified by that seasonal tightness. The cash was available. We have to remember, M2 money supply is still near a record high, something like $22.3 trillion.
So the money's there.
The money is there, but it wasn't flowing to where it was needed on the balance sheets at that specific moment. This sharp, momentary tightness, despite all that M2, means we have to keep a close eye on the SRF and RRP data going forward.
That's a brilliant way to frame it. So you have the long-term pressure of high rates and the short-term chaos of liquidity spikes, which leads us right into market sentiment, which is just divergence.
The total divergence.
We're starting the year with thin trading, low volume, so volatility is amplified, but capital is clearly splitting into two very distinct camps.
Precisely. The market is highly divided, and it just reflects all this uncertainty. The two main themes attracting serious capital are AI and technology growth stocks on one hand,
And on the other,
precious metals and partial safe havens. It's a total divergence of risk preferences. Investors are simultaneously betting on the future and insuring against catastrophe.
but why this specific split? Why buy NVIDIA at the same exact time you're buying gold?
Because high rates punish marginal ideas. Investors are only willing to tolerate risk where the story, the narrative, is absolutely bulletproof. AI is seen as the guaranteed growth story for the next decade.
Right, it can power through the rate pressure.
That's the bet, that it can overcome rates through massive productivity gains. And precious metals, well, they're the ultimate hedge against systemic risk, geopolitical inflation, or, maybe one of these liquidity events we just talked about. They offer different kinds of certainty.
Let's check the risk gauges. The VIX, our fear index, it's still low, but it has ticked up a bit. It closed near the 14-15 range. So general equity fear is, contained.
Agreed. And in the crypto space, sentiment is actively repairing itself. The crypto fear and greed index is in the fear range now, maybe 25 to 34. That's a huge recovery from the extreme fear we saw at the end of 2025.
So the panic is over, but people are still cautious.
Exactly. The panic selling has subsided. Meanwhile, oil is pretty quiet. WTI crude is just oscillating in that $50 to $60 range.
Okay, now for the deep dive on the assets themselves. Let's start with U.S. equities. Where is the defense and where is the conviction?
Defense first, always. Your core ETFs are holding up really strong. VOO, the S&P 500 ETF, is sampling near $628.
And the NASDAQ.
QQQM, the NASDAQ 100 ETF, is near $252 to $254. And its performance is almost entirely driven by that heavy weighting in tech and AI.
And that AI leadership is where all the conviction is. Let's hit some specific price points because I think they tell a story.
For sure. NVIDIA is trading near 188, 189. That level represents this institutional belief that the AI infrastructure build-out is mandatory. It's non-negotiable, regardless of what rates do in the short term.
And Meta.
Meta is showing huge strength near 650, 665. The market is pricing in successful AI integration across all its platforms, plus all the M&A they're doing to snap up talent and tech.
We've also got Alphabet, GOOG, at near 310, 320. Its valuation seems to be tied to, both the ad cycle staying stable and its big investments in its own AI models.
Right. And then you have Tesla, TSLA, which is always a wild card. It's volatile in that 438 to 440 range. Investors there are just laser focused on delivery numbers and any real progress on robotaxi.
And that conviction isn't just based on hope. The news flow shows constant activity. NVIDIA is in talks with companies like Grok.
Right, about licensing and talent. It shows the focus isn't just on making chips anymore, but on deployment speed. How fast can we get this stuff working?
And Meta isn't slowing down. We saw the news, they're acquiring Minos to boost their general AI capabilities. These are huge, multi-billion-dollar strategic moves happening in real time. It's what's justifying these valuations.
And if we shift over to the crypto mainline assets, Bitcoin had that explosive start to the year. Where are we now?
BTC is holding strong. It's consolidating right around that $90,600 mark after it explored those higher levels. And the critical short-term variables here are really straightforward. It's all about ETF fund flows and volume.
So how much institutional money is still coming in?
That's the whole game right now. That dictates the immediate path.
And while BTC is consolidating, we've got Ethereum, ETH, holding its own above $3,000 near $3,100. And Solana, SOL, is organizing right near its year-end highs at about $133.
We should probably touch on the really high-risk frontier too, the pre-stocks. This is the definition of speculative capital.
Oh, absolutely. These are high-risk, often illiquid bets on future IPOs. You need extreme caution here. We see these huge price discrepancies from platform to platform because of fragmented liquidity and regulatory risk.
Like what?
Well, secondary market samples show Anthropic near 320, 325. XAI is around 95 to 100, and OpenAI, it ranges from 980 all the way to over $1,000.
That wide range tells you everything you need to know.
It should signal that this is speculation, not investing. Tiny, strictly defined positions only.
Okay, so now let's flip back to the other side of that divergence. Precious metals. What's so fascinating is how strong they are, even against this incredible tech growth story. Gold is firmly above $4,300 an ounce.
And that strength is not trivial. It suggests there's a deep, persistent demand for systemic hedging. To quantify that, we can look at the comparative ratios.
Give us the ratios. How does BTC stack up against gold and silver right now?
Okay, so based on our sample prices, BTC at 90,600, gold around 43.50 an ounce, and silver at about 73 bucks. The BTC to gold ratio is about 20.9x.
And against silver?
The BTC to silver ratio is much higher, around 12,216x.
So what does that all mean?
It means that while Bitcoin has obviously had a huge run, gold and silver are holding their ground, relatively speaking. They are relatively strong at these prices. If gold were really underperforming, that ratio would be much, much higher. The fact that it's contained shows capital is actively seeking defense, not just digital speculation.
Okay, let's pull all of this together. High rates, liquidity chaos, a tech boom, gold demand. Let's synthesize this into actionable takeaways. What's the strategy in this kind of divided high-pressure market?
The fundamental theme doesn't change. It's seasonal liquidity weirdness plus stubbornly high interest rates. That's driving the divergence between AI tech and precious metals. So the strategy has to be defense first, with highly controlled speculation.
Defense first, so VO and QQQM as your core position.
Correct. We'd advise phased accumulation, dollar cost averaging, into VOO, QQQM to build that stable base. But, and this is crucial, on your AI leaders like NVDA, Meta, GOG, you should be using options for protection.
Like put option.
Put options, for example. Something to guard against a swift reversal if some data disappoints or there's a geopolitical shock.
And on the hedging side?
Hedge where the systemic risk is. That means a moderate allocation to gold ETFs or even limited physical gold. Silver is volatile, but it's suitable for some short or mid-term swing trading, as long as you control your leverage. Strictly control it.
And for the speculation, the crypto and pre-stocks.
Small-scale phased entry for BTC and ETH. And you must have strict stop-loss orders. You can't let a speculative position turn into a long-term liability, and pre-stocks are extreme high risk. Tiny positions, clear exit rules before you even enter the trade.
And finally, cash management. Given what we saw at year-end, cash isn't just for sitting on the sidelines anymore, is it? It's a strategic asset.
Absolutely. Focus on liquidity monitoring. Watch the SRFRP data and maintain sufficient cash or short-term bonds. This is all about duration management. Short-term bonds reduce your duration risk and give you flexibility to deploy capital quickly when the Fed data finally does signal a genuine turning point.
So we've navigated a pretty complex, divergent kickoff to 2026. Learner, the short-term variables you need to watch are clear, the stabilization of that SRFRP data, and of course the next round of inflation and employment numbers.
Indeed. And, given the relative strength of precious metals we saw in that BTC gold ratio and the market's complete reliance on Fed data to justify these high valuations, it raises an important question for you to think about.
Go on.
How long can this AI and tech growth theme maintain its momentum, requiring all this capital, these high future valuations, under sustained interest rate pressure if the employment data doesn't weaken, forcing the Fed to delay cuts even further? It creates a fascinating pressure point for the year ahead.
Something to mull over. Thank you for sharing your sources and letting us guide you through this complex deep dive into the 2026 market kickoff.